The average Australian with $100,000 invested in stocks outside of super has paid more tax on that money than someone who put the same amount inside super, sometimes 2 to 3 times more. And most people making this decision right now have no idea that's even happening. Today, we are going to break down exactly where your money grows faster, why the answer isn't as simple as the internet makes it sound, and what the real cost is of choosing wrong. Because this isn't just an academic exercise. This is a difference between retiring comfortably or not. Let's start with the uncomfortable reality sitting underneath this whole debate. Australia has one of the most tax-advantaged retirement systems in the world. Superannuation is not just a savings account. It is a legally protected tax structure that the federal government has built specifically to let wealth compound faster than it would in your personal name. And yet, the most common question I see across Australian personal finance communities is still, should I just invest in ETFs in my own name instead? And look, I get it. Super feels locked away. It feels distant. You can't touch it until preservation age, which for most people reading this is 60, and depending on when you were born, it could be higher. That restriction feels like a cost. But here's what nobody tells you. That restriction is also what makes super one of the most powerful compounding engines available to everyday Australians. The rules that make super feel frustrating are the same rules that make it incredibly efficient. Most people assume that investing in stocks outside of super gives you more control and therefore more wealth. They think flexibility equals a better outcome. And on the surface, that logic makes sense. You can access the money anytime. You can choose your own investments. You can react to markets, move things around, do what you want. But what that framing completely ignores is the tax drag, and tax drag, over 20 or 30 years, is absolutely enormous. Here's what nobody tells you about the tax treatment of these two environments. Inside super, your investment returns are taxed at 15% during the accumulation phase. Capital gains held for longer than 12 months get a 1/3 discount, bringing the effective rate down to 10%. And if your balance moves into the pension phase, meaning you've retired and you're drawing down, earnings are taxed at zero. Zero. Outside of super, in your personal name, those same returns are taxed at your marginal income tax rate. If you're earning a decent salary, that could be 32.5 cents in the dollar, 39 cents, or 47 cents for higher earners, plus the Medicare levy on top of that. According to the Australian Taxation Office's 2024 tax statistics, over 60% of working Australians face a marginal tax rate of at least 32.5% once their salary is included. That means for the majority of people watching this, every dollar of investment income earned outside of super is being taxed at more than double the rate it would be taxed inside super. Now let's put real numbers on this, because I want you to feel the weight of what that difference actually means. Take $100,000 invested today. Assume a 7% annual return, which is roughly in line with the long-run return of a diversified Australian share portfolio, and consistent with what organizations like Vanguard and Australian Super have projected for balanced and growth options over the long term. Inside super, at a 15% tax rate on earnings, and we're being conservative here and not even accounting for the pension phase zero rate, that $100,000 grows to approximately $534,000 over 30 years. In your personal name, with a 32.5% tax rate on distributions and capital gains, that same $100,000 grows to closer to $380,000 over the same period. That is a $154,000 difference from the same starting amount, just from where the money sits. And I want to be honest about the complexity here, because the after-tax calculation depends on a lot of variables: your income, your fund's investment strategy, whether you're receiving franking credits, how often you're realizing gains. I'll come back to franking credits in a moment because they are a genuinely important piece of this picture. But the directional reality is clear. Tax drag inside super is structurally lower. And over long time horizons, lower tax drag wins almost every time. Now here's where it gets interesting, and this is the part most comparisons miss. Superannuation has another mechanism laid on top of the tax advantage: franking credits. Australian companies pay corporate tax before they distribute dividends, And when those dividends come through to you, the ATO attaches a credit representing the tax already paid. In your personal name, you can use those credits to reduce your tax bill. Inside Super, unused franking credits are refundable. The fund actually receives cash back from the ATO. According to APRA's 2024 annual superannuation bulletin, the industry collectively received billions in franking credit refunds last financial year. Your super fund, particularly if it holds Australian shares, is quietly collecting these credits and returning them to your balance. That's money working for you in a way that simply doesn't show up in a basic calculator. So what's the case for investing outside of super? Because there genuinely is one. Access is real. If you're under 60 and facing a genuine financial emergency, a redundancy, a health event, a business collapse, super is locked up. The ability to access your investments outside of super has genuine optionality value. There's also the flexibility to invest in things super won't let you hold directly. Property in your name, startup investments, concentrated positions in specific stocks. And if you're on a very low income, the tax advantage of super narrows considerably. For someone in the 19% bracket, the 15% super rate is less dramatic. But here's the practical path, because I don't want to leave you with a theory. I want to leave you with a decision framework you can actually use. If you have not maximized your concessional contributions, meaning the pre-tax contributions that currently sit at a cap of $30,000 per financial year for the 2025 to 26 year, start there. Every dollar of concessional contribution goes into super before income tax is applied, and it's taxed at 15%. If your marginal rate is 32.5% or above, you are saving 17 cents per dollar immediately. That's an instant, guaranteed return before a single investment even performs. If you're making after-tax contributions, check whether you have unused concessional carry-forward amounts. The ATO allows you to carry forward unused concessional cap space for up to 5 years, provided your total super balance is under $500,000. That means if you had years where you didn't maximize contributions, and most people have, you may be able to contribute a lump sum well above the standard cap right now and get a significant tax deduction. For the investment platform question, inside super, platforms like Australian Super, Host Plus, and Australian Retirement Trust all offer index-linked investment options with low fees, some below 20 basis points annually. If you want more control, platforms like SelfWealth or a self-managed super fund open up direct share ownership within the super environment. Outside of super, Perla is well designed for long-term buy and hold investors who want low brokerage and automatic investing in ETFs like Vanguard's VAS or VGS. CommSec remains the most widely used platform for those already in the Commonwealth Bank ecosystem. The practical answer for most Australians, particularly those in their 30s and 40s, is not either or. It's a layered strategy. Max your concessional contributions first. Build a liquid buffer outside super, typically 3 to 6 months of expenses, in a high-interest savings account. Then invest additional wealth outside super in low-cost, broad-market ETFs, understanding that you are paying more tax but buying genuine flexibility. The ratio between those two buckets depends on your age, your access timeline, and your income level. Now, here's the cost of waiting. Because none of this matters if you read it, nod, and do nothing. Let's say you're 35. You have $100,000 to invest. And instead of thinking through this properly, you put it all in a brokerage account in your name, because it feels easier and more flexible. Over the next 25 years, assuming 7% gross returns and a 32.5% tax rate, you might end up with approximately $440,000. Not bad. But if you'd put even $70,000 of that inside super and the remainder outside, benefiting from the lower tax environment for the majority of the capital, the combined outcome could be $80,000 to $120,000 higher. Based on your current age, based on current tax law, that's not a best-case projection. That's a reasonably conservative one. And the real sting? The longer you wait to make this decision thoughtfully, the less time compounding has to do its work. $1 inside super at 35 is worth more than $2 inside super at 55, because the compounding has more time to run. Every year of delay isn't neutral. It is a financial cost that shows up quietly, invisibly, in your retirement balance. Before we go, if you haven't subscribed yet, hit subscribe now so you never miss when we break down something the average Australian isn't being told about their money. And drop your answer in the comments. Given what you've just heard, are you planning to shift more of your wealth into super? Or do you think the flexibility of investing outside of super is worth the tax cost for your situation? I read everyone.